You may believe that being a CA, I would not have made the same money mistakes that I talk about so much. है ना? But early in my career, I actually made the same mistakes. I may be giving the best advice to my client, but with my own money, I was actually not that careful. So in today's video, let me share my 5 biggest money mistakes and what can you learn from them. The first and the biggest money mistake that I made in my investing journey is to hold off investing until I had the necessary capital. I had just started working and I thought I didn't have a large enough corpus to start investing. But when I did eventually start investing, I checked my mutual fund portfolio after 10 years and I realized I was up 300%. Now imagine the kind of return that I could be sitting on if I had started investing just a little bit earlier. Do you want to see for which investment do I regret this the most? DMart stocks. I've always thought the corporate governance and the business model of DMart is impeccable. And in the last 5 years, even the fundamentals have shown constant growth. However, the one thing that I regret the most is that I could have made a killing. I could have made almost 100% return when the stock was at 2,500 rupee level back in 2020. But I waited too long for the stock to correct, even when the stock was showing no signs of correction and it was making new highs every day. My procrastination got in the way. When I realized this, I did the next best thing. I started my SIPs. Now it's easy to see that doing a lump sum investment can get you a better return than doing small investments over time. But you see, cost averaging provides 3 key benefits that can get you better results. And these are, it will help you avoid mistiming the market, it will take emotions out of investing, and it will make you think long term. Using SIPs can be especially powerful during recessions and bear markets. Committing to this strategy means you will be buying when the market is down. And that's when you can potentially score the best deals. Now, you never know what the market is going to do next month. But by investing regularly, while the market is up and while the market is down, you will average out your cost. That means most probably your cost will be on a lower side. When I had just started my career, I was not in favor of taking any risk with my money. Well, it was my hard-earned money. Why would I risk it by investing in stocks? So most of my investment was in FDs and debt mutual funds. However, after a year, I was looking at how much returns my investments have generated. And as an afterthought, I created an Excel to check how much return would I have got if I had invested the same amount in an index fund. Now, I kind of knew what was going to come, but the results were a shock. My returns were low, and by low, I mean extremely low. So even as my capital invested in the FDs did not fluctuate like it would have if I had invested in stock market. But tax and inflation made an ultra conservative investor like me poorer. If you think this has happened with you as well, do hit the like button. This made me realize that if age is on your side, then investing only in the safest instruments is not the best choice. If you're just starting out, and that means you are decades away from retirement, then you need to understand that stocks may be volatile in the short term, but they will give you much higher return in the long term. Actually, your risk profile should also align with the investment time frame that you have. Since direct investing in stocks is riskier and time consuming, you can invest in equity mutual funds which are professionally managed. Now, as a conservative investor, you can create a portfolio wherein you are investing 25% in stocks, 45% in bonds, and the balance 30% in gold and money market instruments. In a good year, you may see around 10 to 12% return with this portfolio, and in a bad year, your portfolio may decline by 5 to 10%. We have actually seen how to structure your portfolio in our mutual fund video, which is linked in the description. Remember, prioritizing short-term capital preservation over long-time wealth generation can leave you worse off. I had actually delayed buying a health insurance when I first started my job. This could have been a big mistake, but fortunately I rectified this unwittingly. At the end of the first year, I realized that I could get the tax benefit for the premium paid. I was young and the benefit of insurance was still not on my radar. So, lucky coincidence. See, when an insurance company is assessing you as an applicant, they are looking at the risk that they will have to pay you money. For insurance companies, the younger you are, the lesser the risk. See, young adults are generally healthy and are less prone to chronic diseases, which means a lower premium for you. However, on the other hand, advanced age is a sign of increasing health issues, and that means increasing chances of claim. And that's why the monthly premium is also higher. You can clearly see that the cost of insurance premium grows in direct proportion to your age. One common doubt that people have is, what if they are covered under a corporate health plan? Should they increase their expense by taking another private health insurance policy? My answer, you should have your own health insurance policy as well. See, the policies offered by employer do not exceed cover of more than 2 lakh rupees in most of the cases. This is good only for small illnesses. Remember, the health insurance provided by your employer is a perk at your job. It's not a mandatory feature. So the management can remove certain benefits. They can make you pay the premium. They can even end the policy if they want during the times of financial crisis. The terms and conditions of the policy are decided by the employer and the insurance company. So what critical illnesses are to be included, the minimum and the maximum co-payments, the limit on the room rent are all decided for the convenience of the employer. You are not in control here. Employers and the insurance companies try to reduce cost by including restrictions like co-payment and room rent limiting clause. Co-payment means you will have to make the part payment for the expense and the other part will be paid by the insurance company. Similarly, room rent limit means that the insurance company will pay for the room rent only up to a certain amount. So, buy health insurance early and do not make your employer's health insurance as your only health cover. If I made the mistake of not investing in DMart early enough, I've also made the mistake of investing in a company for too long. Too often, when we see a company do good that we have invested in, it's easy to fall in love and forget that we bought the stock as an investment. We still stick with the company even when the fundamentals have changed significantly. My example, Yes Bank. At one time in August 2018, Yes Bank was trading at around 360 rupees and the then MD and CEO Rana Kapoor had vowed never to sell this stock. Right now, the stock is trading at 17 a share compared to its all-time high of 404 in August 2018. Though there was a lot of negative news surrounding Yes Bank from July 2019 to March 2020, most retail investors did not exit the stock. As a result, retail investors like me lost more than 3,000 crore on their investment in Yes Bank. My learning from this investment was never to fall in love with the stock. Always keep an eye on the fundamentals and cut your losses quickly if the fundamentals have changed for the negative. Another mistake that I made was continuously buying and selling stocks. It only increased my expenses and taxes. For any stock sold through Demat account, your stockbroker and the Demat account service provider will charge you the brokerage and some fees. Now this fees is very small, but it can add up to a significant amount if done frequently. Equity investment gains are either taxed as short-term capital gains or long-term capital gains. If you would sell your shares before 1 year, you would attract 15% tax on your gains and you would need to pay this irrespective of your income tax slab. So every time you sell a winning stock, the tax will eat up into your returns. Now, if you hold your stocks for long term, and this long term is only 1 year for tax purposes, first, on the first 1 lakh rupee gain, you will not need to pay any tax. And even after that, you will only be paying 10% tax on your long-term capital gains. Investing is important to build wealth in the long term. And that means you need to start taking small steps as soon as possible and keep improving your financial literacy. I hope you will learn from my financial mistakes and not do them yourself. If you like this video, then go ahead and hit the like button. We do such financial education videos every week. So if you want to grow your wealth, click subscribe and press the bell icon. Wrapping it up, this is Paritosh signing off.